Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to show you how to calculate depreciation and how it fits into all the financial statements. This company is called Slippers Beyond Retail. It started business in January 2019. In all of 2019, there were 4 transactions. The first is we were paid $60,000 from our customer for the products we sent them. The second is we paid our supplier $30,000 for inventory. The third is we purchased a machine for $25,000 from the manufacturer. And the fourth is we paid the IRS $2,500 for taxes. In this video, I am going to mainly focus on the machine and the depreciation. We purchased a machine on January 1st, 2019 for $25,000. We're going to depreciate this asset over 5 years. That's called straight line because the same amount is being depreciated each year, $5,000 each year for 5 years. On the 2019 income statement, we're going to see a $5,000 depreciation expense. Also on the 2020 income statement, 2021, 22, and 23. Then after 2023, the value of the asset on our balance sheet is zero. When you purchase a fixed asset like a machine or a building, you have to record it as an asset on your balance sheet. This line item right here in the asset section of our balance sheet is property, plant, and equipment, $25,000. This $25,000 line item stays on the balance sheet for the life of the asset. To record the depreciation each year, we add to the accumulated depreciation line. In the first year, we put a negative $5,000. That means the value of the asset, according to the balance sheet, is $20,000 at the end of 2019. The balance sheet is where you store information. The income statement is where you report your profit and losses. So in 2019, we're reporting a $5,000 expense on the income statement. You may be wondering, why don't we report the entire $25,000 on the income statement? When we initially looked at the asset, we felt the expected useful life was 5 years. That's why we depreciated over 5 years. So we're spreading the $25,000 cost over 5 years. So let's look at our income statement. We had revenue, sales of $60,000, cost of revenue of $30,000. Our gross profit was $30,000, revenue minus cost of revenue. Then we have to deduct all our operating expenses. The only operating expense was depreciation. So $30,000 minus $5,000 gives us $25,000. Our operating profit is $25,000. We have to pay taxes of $2,500. So our net income is $22,500. Net income is also referred to as the profit or loss. But remember, this is accounting profit or loss. It's not actual cash. To figure out how much cash we generated, we look at the statement of cash flows. The top part of the statement of cash flows is the cash flow from operations section. Think of the cash flow from operations section as converting net income to cash. So to calculate CFO, we take net income, then we have to add or subtract the non-cash items that we pass through onto the income statement. The only non-cash item was depreciation. Since we passed through depreciation as an expense, it brought down our net income. We have to add that back to the cash flow from operations section. So our CFO for 2019 was $27,500. Now, if you look on the income statement, we had gross profit of $30,000 and we paid taxes of $2,500. $30,000 minus $2,500 is $27,500. That's how much cash our operational business generated in 2019. But remember, also in 2019, we bought a machine for $25,000. That detracts cash because we had to pay for that machine. So we have a capital expenditure of $25,000. So our free cash flow for 2019 was cash flow from operations minus CapEx, $2,500. Our entire business generated $25,000 of cash flow. Even though our business had $22,500 of profit, we only generated $2,500 of cash flow. So when you purchase a fixed asset like a machine, you have to report the entire expense on the statement of cash flows in the year you purchased it, which we did. Then in future years, you pass through part of the expense onto the income statement. Depreciation is a non-cash item. It's just an accounting measure to spread the cost of an asset over a long period of time. That's why we add the $5,000 back on the CFO section, because we already recorded the entire $25,000 expense in the year we purchased the asset. So in 2020, there's only 3 things that occurred. We received $60,000 from our customer for the products we sent them. We paid $30,000 to our supplier for inventory, and we paid $2,500 to the IRS for taxes. Those are the same exact 3 things that happened in 2019. The only thing that didn't happen in 2020 is we did not purchase a machine. So if we look on the balance sheet, property, plant, and equipment, it's still $25,000. It will say that way. But we have to change accumulated depreciation. We have to add another negative $5,000. So now accumulated depreciation is negative $5,000 from last year plus negative $5,000 from this year, negative $10,000. So the value of the asset at the end of 2020 is $15,000 according to our balance sheet. And the income statement is identical to last year. Same revenue as last year, same cost of revenue, same gross profit. The only operating expense was depreciation. Our operating profit was $25,000. We paid taxes and net income of $22,500. Now the statement of cash flows will look different. The cash flow from operations section will be the same. We take the net income, then we have to add back the non-cash items from the income statement. Now our cash flow from operations is $27,500. Remember, cash flow from operations converts net income to cash. We had no capital expenditures in 2020. In 2019 we did, but nothing in 2020. In 2020, we generated $27,500 of cash flow, but reported $22,500 of profit. Some years, free cash flow will be greater than net income. Other years, it will be less. We purchased the machine in 2019, and we expect it to last 5 years. It might only last 3 years. It might last 10 years. It doesn't really matter. We paid the $25,000 for the machine, and we're going to spread the value of the machine over 5 years. Depreciation is just an accounting measure. It's not real life. Real life is cash. That's why you should be looking at the statement of cash flows in addition to the income statement. Once you understand how the balance sheet, income statement, and statement of cash flows are connected, then a lot of things will start to make sense and you'll become a really shrewd investor. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.